For more on the markets, we're joined by Ed Yardeni, president of Yardeni Research. I don't know if you heard our earlier conversation, but we were talking about just the overall sustainability of the bad news is good news dynamic. Curious to get your thoughts on that.
Well, I think that it's interesting how emotions have shifted here in the market. Last year and at the beginning of this year, there was widespread concerns about a hard landing. Now it seems as though most investors are rooting for a soft landing instead of a no landing at all. And so here we are. We're seeing the soft landing that the market has been looking for, and the market's reacting exactly as everyone anticipated it would. It's rallying on the news that things are slowing down, which is good news. It takes the pressure off inflation and reduces the likelihood that the Fed is going to be raising interest rates again.
So, Ed, are you calling mission accomplished here? Do you think this is, we're out of the woods for any kind of hard landing, despite some of the headwinds we were just talking about?
Well, as you know, that's a jinx. I don't want to jinx it. I guess, since I don't matter that much, I think it's mission accomplished. I just don't want to hear anybody at the Fed's saying mission accomplished, because that would definitely be a jinx. I like what Powell said. Powell said mission is not accomplished.
Hey, Ed, you've written a lot about why this is not the 70s. Part of your thesis involves the percentage of the labor force that's in a union, which has obviously come way down, and it won't reinforce that spiral effect of COLAs meeting, say, rising energy prices. But today, B of A does have a graph looking at labor on the rise as a percentage of U.S. GDP, and I wonder if you think that poses any threats to potential wage spirals.
I don't think so. I think that labor is going to get what it deserves, and historically that's related to productivity. We have, in fact, seen wages rising faster than prices this year. After basically for 2 years, wages rising no faster than prices. We had stagnant real wages. Now real wages are increasing, and that can only happen sustainably if productivity is making a comeback, which is really my story. And so at the heart of my so-called roaring 2020s thesis that from here on, as miserable as the first few years of the decade has been, technologically driven productivity is going to make a huge difference to economic growth, real wages, and profitability.
Ed, am I remembering right that you were running with a 4,600 S&P 500 target, and you didn't elect to lift it when we got toward that level at the highs? You had a little bit of a shakeout where we're within hailing distance of 46 again. So do you feel as if it's time to reassess, or does that still feel like a fair value?
Well, rather than change my year-end forecast, I'm starting to talk about 5,400. By the end of next year. So what I'm communicating is I think it's still a bull market, and that I really can't call exactly where it's going to be at year end. 4,600 still feels like the right number relative to a fairly optimistic outlook for earnings and a valuation multiple that's here almost around a forward PE of almost 20. And that's largely because of the mega cap 8, which have a forward PE of around 30. So I'm going to leave it at 4,600, but I'm going to, at the same time, say this is whatever happens by year end, it's still a bull market.
Yeah. And I guess the other question is, as we keep talking about characterizing what kind of landing this might be, we were discussing what we were hoping from the Fed. You say you don't want mission accomplished. Of course, I always think back to 1995, which is the dream scenario everybody grabs for. And there was a cut. The Fed kind of finished up the tightening cycle, got ahead of inflation, didn't have to chase it, but did cut rates. And then it became kind of, the Fed almost was out of the picture in terms of the relevant dynamics for the stock market. Can we hope for something like that?
I would love to stop talking about the Fed and start just talking about the underlying strength of the economy itself. I think we're basically seeing a normalization of interest rates. If you look at the bond market before the great financial crisis, 2003 to 2007, the TIPS yield, the 10-year TIPS yield was around 2.5%. And the inflation premium within that spread between the nominal and the real bond yield was running around 2 to 2.5%. So I think we're back to 4.5% is kind of where the 10-year should be. And the stock market's saying, that's fine. We can live with that.
What about the correlation between bonds and stocks at this point? We've seen kind of that oscillate over the course of the year. Do you think that will continue as the prospect for a pause and potentially a cut as soon as May, according to the market, really comes into focus?
Well, you know, when we got above 4.25% a couple of weeks ago, that 4.25% on the 10-year was the peak last year. So everybody kind of got spooked that we're going to go to 4.5%, 5% in a heartbeat. But then we came down below 4.25%. I think the fact that we haven't really shot up and that we're back below 4.25%, I think has helped the market hold the 50-day moving average, basically, and now we're above it instead of below it. So the bonds are calling the shots for the stock market, and right now the bonds are saying it's clear sailing for now, which is kind of interesting because everybody's fearing that September is a bad month historically, but it's not always a bad month, and it could be a good month.
Yeah, you got the 10-year now back above 4.10, so significant moves today. Ed, thank you.
Thank you.